Can I hit that?
Yeah, sure.
I'm a
Yeah.
Bitcoin maxi, to be clear, which means for digital assets, I focus on Bitcoin because I'm so concerned about the fiat system. So having
Right.
spent my life in fiat, I want insurance against the fiat Ponzi. And Bitcoin, with its fixed supply and largest market cap in the digital asset ecosystem, I feel that Bitcoin is the best digital asset. But I don't ever advocate anyone to go 100% into Bitcoin. No, I think regulation and clarity on regulation would be a huge positive for the digital asset space, and Bitcoin for me in particular.
Sure.
A lot of big money players need to have exposure to Bitcoin. I'm going to point out that BlackRock just announced an allocation to Bitcoin within their global asset fund, right? So a huge fund that now has a sleeve where they can invest in Bitcoin. Can I hit that?
Yeah, sure.
I'm a Bitcoin maxi, to be clear, which means for digital assets, I focus on Bitcoin because I'm so concerned about the fiat system. So having spent my life in fiat, I want insurance against the fiat Ponzi. And Bitcoin, with its fixed supply and largest market cap in the digital asset ecosystem, I feel that Bitcoin is the best digital asset. But I don't ever advocate anyone to go 100% into Bitcoin. That would be irresponsible risk management. I don't tell other people not to do that if they have the conviction. But the beautiful thing about Bitcoin and its asymmetry to the upside is you only need to hold between 5 and 10% of your entire portfolio in Bitcoin to participate in the incredible asymmetric upside. And that's the way you manage risk, as far as my career has taught me. Well, it's all a question of probability. So it certainly is possible. That being said, I do not think it is likely. But what do I know? I'm just a betting man in the markets like everyone. The reason I have some concerns, well, twofold. Firstly, people need to understand that inflation actually compounds, right, Paul? So achieving a 6.5% inflation rate after 8% readings in the past, that's not that substantial, given that you're building on 6.5% on a base of 8% to begin with. So, we could go 8%, 6.5%, 4%, 2%, -4%, -6%, and you'd still have a positive inflation rate over the last 5 years. And this is not good. I'm not the only one, and most people shouldn't really care what I say, but I think Jamie Dimon is saying the same thing. CEO of the largest bank in America, he has data that he's privy to data that no one else is, and he believes the Fed might be getting a little ahead of themselves and perhaps a pause is warranted. But I'll just, paraphrasing Jamie Dimon, we're by no means out of the jungle or out of the woods yet, in my opinion. So going into the digital asset space a little, having spent my life in it as a trader, I do know one thing. When everybody's anticipating something horrible to happen, it's generally, a lot of it's already priced in. And, this thing with DCG, if I'm not mistaken, you said they owe $3 billion, right?
Yep.
$3 billion is nothing.
Nothing.
It used to be a lot of money. $3 billion is not a lot of money anymore. Okay. And we have to put it in the context of, firstly, a Bitcoin market cap that's over 350 billion. So 100 times the size. We have to put it in the context of 3 billion in the context of, trillion-dollar banks. Okay. Like trillion-dollar asset Bitcoin pumping. It's hard for me to get excited about Bitcoin at 19,000, but the recent increase in the price of Bitcoin could largely be due to short covering, whether it's people that were short the Bitcoin mining industry as a correlation, and therefore had a Bitcoin position that might be needed to cover as well. So Bitcoin miners, look at some of the performance of, let's say, Marathon stock. Okay, Marathon, the largest the largest publicly traded Bitcoin miner, its stock is up 100% in the last 3 weeks. Okay, that's tax loss selling at the end of the year. So mom and pop retail that are selling Marathon stock for tax loss purposes. but the stock is actually up 100%. So this trickles through in various different ways. It could actually impact things for DCG positively. With respect specifically to GBTC, I'd like to talk more about that if you want to focus on the GBTC. But for now, all I know is, Paul, when everybody's talking about something, generally it's priced in. And everybody's been talking about the collapse of DCG and all of that for, 3 or 4 months now. Could it be priced in? I'm just going to play devil's advocate and say, yes, it could be priced in. Firstly, so DCG Group is the largest holder of GBTC shares. I think they own 67 million GBTC shares, and the next largest holder is Cathie Wood with something like 7 million. Okay, so DCG owns 10 times the volume of GBTC shares. Most of those were accumulated, I'm told, due to the 3 Arrows capital selling and other hedge fund blowups that were trying to trade the discount to net asset value. And when that blew up, when they blew up, they had to sell their assets. So DCG owns 67 million shares of a trust, GBTC, that trades 4 million shares a day. Whoa. So that's an awful lot of supply. Now, I'd be surprised. That being said, nothing, in the digital asset space, nothing surprises me. You can't always use a traditional finance playbook in the digital asset space because, firstly, there's a lot of inexperienced CEOs in the digital asset space that don't understand the process of traditional finance restructurings and bankruptcy. And then secondly, there's so many people out there that just don't take at face value what someone like Sam Bankman-Fried claims, rightly so. So, there's the person right now that holds the cards is Barry Silbert over Gemini. And he doesn't have to give up those cards in the event of a restructuring. He still holds those cards. So I don't anticipate it. But again, look, I'm not commenting on this from, I'm not behind the wall. Well, if I was, I couldn't comment on it. But even if I was studying the situation closely, don't take my word for it. You cannot use a traditional finance playbook within the digital asset space. It just, again, is too young. It's too many different players that don't understand the systems. No, I think regulation and clarity on regulation would be a huge positive for the digital asset space and Bitcoin for me in particular.
Sure.
A lot of big money players need to have exposure to Bitcoin. I'm going to point out that BlackRock just announced an allocation to Bitcoin within their global asset fund, right? So a huge fund that now has a sleeve where they can invest in Bitcoin. It is only Bitcoin futures, but it doesn't matter. It's got exposure to the asset class. As regulatory clarity emerges, I think you'll see more large investment managers have the desire to allocate to the Bitcoin asset class. Why? Well, because there are arguments that it is a diversifier. It's so the correlations are different to other assets. But from my perspective, having spent my whole life in bonds and the fiat markets, I view Bitcoin as actually being insurance on the fiat markets. And you should want to own insurance on the fiat markets, much like you own fire insurance on your house. I don't want the fiat markets to break. I don't want my house to burn down, but I own insurance on both of them because I'm concerned with things like the debt spiral in the fiat system. Well, if that is the case, you want to own hard money. And the hardest form of money is Bitcoin. But I'm not saying don't own gold, because I own gold as well. And I own silver, I own other hard assets. This is why I don't say you have to be 100% in Bitcoin. All I do know is you should take your allocation to Bitcoin, not from your gold allocation, before you take your allocation to Bitcoin from your fixed income allocation. So there's the low-hanging fruit, in my opinion. And you mentioned low-hanging fruit regulatory. Yeah, when that clears up, you will have diversified asset managers that might say it's no longer 60-40, it's 60-20-20, And the 20% new is called alternative assets, of which a sleeve is 5% digital assets, because that's the only way you're going to keep up with the fiat debasement. And that's the mathematics I like to bring to the table, Paul. It's grade 11 math. Fiat's debase. It's 100% certain that fiat will debase. You need protection against that. The best protection, in my opinion, is Bitcoin. That being said, I don't have all my hard asset money in Bitcoin. I have it spread amongst other hard assets as well. 5 years is a pretty short time. I try to look out decades, and I think that it'll be a process where it's possible that you have Bitcoin that exists side by side with a global currency called the US dollar, that they actually support one another. Think of Bitcoin as being your savings account, and think of digital currencies, whether it's central bank digital currency or still the fiat that is essentially digital as well. That's your checking account. Fiat is really good for global trade. I mean, you don't want to have to use barter for global trade. It's good to use fiat. There will be, in my hope, in my opinion, a parallel network that develops, because when you switch from a network, let's say you're internal and you go, I'm going to switch from Microsoft to Apple. You don't turn your old Microsoft system off on a Sunday and come in on a Monday and turn on your new Apple system and just trust and fingers crossed that everything's going to work. Right. It's a parallel network that you study. So I think that there'll be and I believe this to be the case, if the United States were to embrace Bitcoin, it could ensure the survival of the US dollar as global reserve currency, not global reserve asset, but global reserve currency. The US Treasury bond as global reserve asset is in danger. I think it will be supplanted by Bitcoin, but to have two of those still, Bitcoin as your as your savings account, fiat US dollars as your global reserve currency or checking account. So savings in Bitcoin, checking account in US dollars. I think that's a successful recipe. And that doesn't happen overnight. That'll take a decade or more. The Canadian dollar is a rounding error in the global financial spectrum, and it will fail a decade or 2 decades before the US dollar ultimately fails. So these are the kind of warning signals you could look for, in my opinion.